Good evening. Let me welcome you to our webinar on predictive business analytics. I think this is a specialized webinar that we are having, and we have someone of great experience who will be handling this. He's been with us on earlier occasions, and he is no other than Mr. Gary Cokins, who is an internationally recognized expert speaker and author in advanced cost management and performance improvement systems. Now, if you look at our webinars, now these, I think the 9th webinar that Gary is having with us, and a part of the performance-based strategic management accounting that he has specialized in. Gary is a graduate of the Cornell University and Northwestern University's Kellogg Graduate School of Management, and his career includes prestigious positions as a strategic planner, financial controller, and production manager with FMC corporations, a management consultant with some of the leading audit firms, Deloitte and Touche, KPMG, Pitmavic, and also as the head of the National Cost Management Consultant Services for Electronic Data Systems. And Gary serves on activity-based information committees, including the Consortium for Advanced Manufacturing International, or CAMI. Now, Gary has also been associated with the International Management Accountants of USA. He's been the professor there, a professor in the management accounting area. And recently, CMA Sri Lanka was also proud to have awarded the fellowship of the Institute of Certified Management Accountants of Sri Lanka to Gary. So we have an expert who's with us, and he's also the founder of the analytics-based performance management advisory firm located in Cary, North Carolina. So over to you, Gary, and thank you very much. I think it's morning there. Good morning to you, and welcome to the session.
Well, thank you, Lakshman. Can you successfully see my landing page?
Yeah, we can see. Fine,
great.
Fine. Thank you.
All right. Well, thank you for inviting me again. Yes, I think this is my 9th webinar for the ICMA of Sri Lanka. Thank you very much for the privilege of having me be a fellow with your organization. For those who are attending, if you want to ask questions, there may not be time. This is a long presentation. There is my email address, gcokins@garycokins.com. You can send me an email there. My website also has a way to communicate with me. And feel free, if you care, to invite me to connect in LinkedIn. So let's get going. A little bit more about myself. Yeah, my Cornell degree was actually in industrial engineering and operations research, which involves analytics, which we'll talk about. And there's my MBA. I also finished my career 8 years ago. I retired after 16 years with SAS. Many of you may recognize or may not recognize SAS. It's the world's largest privately owned software vendor, 15,000 employees specializing in analytics. So, and also I just want to mention, in the United States, on the evening news, we are seeing what is happening in Colombo and Sri Lanka. And I know it's a lot of turmoil. We have turmoil here in the United States, but I just want to share with you, the moon will still show up, the sun will rise, flowers will bloom, babies will cry. This will all work out in the long run. So just be optimistic. Okay, let's go. Who will benefit from this presentation? Managers who have previously struggled at promoting FP&A, financial planning and analysis, corporate performance management, and integrating business analytics into their decision support systems. Managers who want to prepare for the impact of artificial intelligence and robotic process automation on the accounting functions. And then finally, managers who intend to champion any or all corporate performance management and business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is because it's my observation that although it's nice for senior executives to sponsor new initiatives or innovation, often they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart who are passionate and ask themselves, how long do I want our organization to continue to perpetuate stale or arcane methods, or maybe not even analytic methods? So if you are 3 or 4 levels down in the org chart, that's fine. I like presenting to you too. Yes, this presentation will be based on a book I co-authored with Larry Maisel. I met Larry many years ago with KPMG. Chapter 1 is a free download. That link is at the bottom of this slide. And you don't need to buy the book, just look at chapter 1. So my agenda, I'm going to basically show a stages of maturity diagram of analytics, answer why is analytics even needed? What is it? Try to define it. I'll give you some broad examples of analytics that are in many, many different parts of the business. Then I'm going to give several examples specifically how analytics apply to the CFO finance and accounting function. I'm briefly going to talk about the digital revolution from artificial intelligence and robotic process automation, and then I'll conclude with benefits. So here is the continuum. When we look historically, I always like to refer to it through the rear view mirror of the car. We start with descriptive analytics, typically using visualization, pie charts, histograms. Then we move to diagnostic analytics. Notice you'll see there's that black dot that's off of the exponential line. It's an outlier, some strange event, maybe fraud detection, perhaps. Then when we go through the windshield, we start with the predictive view. And when I did author that book many years ago, I thought, well, that's Mount Everest. That's the highest you can go. But then more recently, prescriptive analytics has come to be the highest stage of maturity. It's really about optimization of all the choices we could make. How do we determine the best choice? I like this slide from the AICPA CMA. It kind of shows the accountants' roles as they progress for supporting decision-making. We start with data capture and reporting, maybe some analysis. And with the analysis, we get some insights. But notice the 3 bubbles to the left, then we actually make decisions based on the insights and influence the organization and then have impact. Notice at the bottom, though, the comfort zone of accountants is typically the 3 or 4 bubbles, circles to the left, but the real value comes with the circles to the right. So why is business analytics even needed? Well, I hope some of you may have an MBA. This is going to be like some MBA speak. How does an organization gain a competitive advantage? We could start by being the first to market with innovation. An example would be Apple. You remember their PC computer, their iPhone. Next, by customer loyalty. In the United States, an example of we have a jewelry retailer, Tiffany's. And finally, low cost, low price provider in the United States, Walmart, big, retail store, or maybe some other. But my question is this: how sustainable are these, if you will, strategic methods in the long term? And I want to draw on work from the famous Harvard Business School professor, Michael Porter, who writes so much on competitive advantage. He basically alleges there are 3 generic strategies: cost leadership, differentiation, and focus. I will next define them, because isn't competition ultimately about those 3? Well, cost leadership strategy is accomplished via improving process efficiencies, having unique access to low-cost inputs, vertical integration, avoiding certain types of costs. The differentiation strategy is accomplished by developing products and/or services with unique traits that are valued by customers. And the focus strategy is accomplished via concentrating on a narrow segment of entrenched customers with loyalty. My question is, don't each of these 3 commonly accepted strategies have risks today? The answer is yes. Why? Because all 3 of them are vulnerable. They are vulnerable. Let's start with the cost leadership strategy. In the past, competitors may take a year or two to lower their costs to your level, but with agile methods, lean management, Six Sigma quality, they may be able to lower their costs in 2 to 3 months, much quicker. Differentiation strategy, imitation by competitors, changes in customer taste. Why is this vulnerable? A good example is, let's talk Apple again. They came out with the iPhone, but within a few months, Samsung and other phone manufacturers had similar products. And finally, the focus strategy. Broad market cost leaders or microsegmenters can invade and erode your customers' loyalty. A good example, Amazon. In the beginning, Amazon was just a website that basically was selling books. It was replacing the bookstore. Then they broadened off almost like, a retail store selling clothing and washing machines, refrigerators. Today, they're actually invading the space of the television networks with their streaming. So my belief is, since these 3 generic strategies are vulnerable, then the best defense is agility with quicker and smarter decision-making using statistics, analytics, and operations research. So I'm not really saying analytics is a strategy, but you're going to need those skills to basically be competitive. So what is business analytics? Well, there is confusion and lack of consensus about it. Is it a data warehouse? Is it data mining with drill down and reporting, like looking at, invoices or purchase orders and drilling down to an unusual line item in them? Is it business intelligence with enhancements? And in a few minutes, I'm going to describe why business analytics is a stage above business intelligence. Business intelligence has been around for over 10 years. It's primarily about reporting. Is it data governance, data management, data quality? That's really the responsibilities of the IT department, the information technology department. Is it probabilities and statistics like regression, correlation analysis, forecasting, optimization equations? I'll be describing them in a few minutes. Or is it all of the above and perhaps even more? Well, what analytics does is it basically increases your knowledge. So I'm going to use this grid here with the 4 squares. The vertical axis is the ability to know something. Unknown at the bottom, known at the top. The horizontal axis is the ability to control something. Uncontrollable to the left, controllable to the right. When we use analytics, notice what just happened. The upper right square expanded. Basically, it means we now can know a lot more and we can control a lot more. So the convergence of data and technology is creating career opportunities in data science that can be leveraged by accountants to increase their efficiency and improve their effectiveness and actually help contribute to the performance of their organization. Now, definitions. Basically, here's a definition from the second book authored by Tom Davenport and Jeannie Harris. The first book, and you may want to write this down, it was the breakthrough book. It's titled Competing on Analytics. Competing on Analytics. And in this second book, the definition was, or is, data, statistical and quantitative analysis, explanatory and predictive models, and fact-based management to drive decisions and actions. But I also picked up a blog by Tom Davenport. That's a broader definition. Business analytics can be defined as the broad use of data and quantitative analysis for decision-making within organizations. It encompasses query and reporting, but also aspires to greater levels of mathematical sophistication. It includes analytics, of course, but let's assume the term business involves harnessing the analytics to meet defined business objectives. So business analytics enables people in an organization to make better decisions, improve processes, and achieve desired outcomes. It brings together the best of data management, analytic methods, and the presentation of results. I kind of oversimplify it. I just say, let's just work backwards with the end in mind. What do I mean by that? Identify a problem or an opportunity where applying analytics can help resolve that. So regardless how we define analytics, I could have put a Wikipedia definition here too. There should be no argument as what is the purpose of analytics. It is better decisions, better actions. Analytics goals should be to gain insights and foresight and to solve problems to make better and quicker decisions with more accurate and fact-based data and to take actions. It's the use of internal and external data. By external data, I mean going to the internet, Google searches to get and collect information to provide a competitive advantage to an organization. So I want to start contrasting business intelligence with business analytics. This is sort of a humorous quote at the top. There is no intelligence in business intelligence. What that really means is people criticize BI because it's primarily about reporting. So business intelligence is about query, drill downs, and reporting. But in contrast, what business analytics is about is investigation and discovery. So to compare the two, business intelligence consumes stored information, like from a general ledger, like from purchasing system, payroll system, invoicing system. But what business analytics does is it produces new information from the stored information, including information surfaced by business intelligence. And then what the corporate performance management methods does is they will deploy the analytics in the context of a method. And I'll give some examples later. Those of you who have attended some of my previous webinars, just a quick description of corporate performance management or enterprise performance management, CPM, EPM, they're synonymous. It's not a process, it's not a system, it's actually the integration of multiple methods like profitability analysis, like enterprise risk management, like driver-based budgeting and rolling financial forecast, like process improvement, like lean management. All of these moving parts seamlessly fit together. So insights and actions. Queries answer questions. What business intelligence does is it creates questions. Business analytics then stimulates more complex and more interesting questions. And most importantly, business analytics also has the power to answer the questions. And I'm going to get a little serious here, although some of you may be saying, Gary, you sound like you're really serious. No, I'm a funny guy, but this is serious. I believe in the past, the best executives and the best leaders had the best answers. Today, I do not think that is the case. Today, I think the best executives and the best leaders have the best questions. This is because there's too much uncertainty. There's too much complexity. There's too much volatility for those executives to rely on their intuition or their gut feel or the types of answers they had earlier in their career that got them promoted to the top. They need to create a culture of investigation and discovery. So a little bit of textbook information here. Let's start to define some just statistical terms. I'll start with the descriptive ones looking through the past and then the predictive ones in the future. We start with distribution curves. They're bell-shaped, mean, median, standard deviation, and sometimes the distribution curve is skewed to the left, skewed to the right. Correlation. This involves dependency relationships among variables. Segmentation, dividing groups into subgroups and maybe subgroups. The marketing function, they're many years ahead of the accounting in terms of using analytics. They've been using analytics for a decade. And when they segment customers, it isn't just, male, female, gender, or old, young. They may have 15 or 20 types of micro segments of their customers so that they can have marketing campaigns for each of them. Cluster analysis, grouping objects that are more similar than other objects. An example of this might be if the marketing looks at their customer master file and they say, hey, here's a similar group of customers that bought A, B, and C products from us. But here's a similar group, similar to them, they've only bought A and B. Well, let's do a marketing campaign. Let's give them price discounts, coupons, offers, so that that group will buy C. In the predictive view, we have hypothesis testing. This is popular with PhD candidates in universities that want to become professors. They have to do a thesis. They have create a hypothesis and test it, valid or not valid. And then regression, forecasting dependent variables from independent variables. Now, correlation, there's a phrase, correlation is not necessarily causation. There can be coincidences. And so this graph is interesting. It's comparing the number of people who have drowned by falling into a swimming pool and then the number of films in a year that Nicolas Cage appeared in. So to the left, vertical axis, this is the count of number of drownings. To the right, the number of films each year Nicolas Cage appeared in. Look how similar these graphs are. But it doesn't necessarily mean that, geez, each time Nicolas Cage basically is in a film, more people will drown. There's no connection. So it's just sort of a rule. Correlation is not causation. Now let's talk about predictive analytics. I love this cartoon. Look in the left of the cartoon, there's this boat. 3 people are in it. The guy in the front is back and he's looking at his computer screen and he's saying, my real-time analysis says it's smooth sailing ahead. Well, it's not. They're about to go over a waterfall. So predictive analytics, the way I like to think about it is answering which X is most likely to Y. So here's some example, retail merchandising. Which product in a retail store can generate the most profit without carrying excess inventory, but also not having period of stockouts? It's kind of like a production and inventory control thing. Customer profitability. Which customer will generate the most profit lift with our least effort? We're all familiar with the acronym return on investment, ROI. Well, this is about return on customer, ROC. And finally, employee retention. Which of our employees will be the next most likely to resign and take a job with another company? And before I left SAS 8 years ago, they were releasing a product. SAS has many analytical products. And what it would do is it would look at the last 3 years of the employee master file of all the employees who left the company voluntarily or involuntarily. It'll look at all the traits about them. How old were they? What university did they go to? What was their salary level? What was their salary increases each year? For all I know, what's the color of their hair and the color of their eyes? And then it would take those characteristics and traits, hit calculate on the existing employee master file, and rank ordered at the top would say, this is the next employee most likely to leave our company because they have very similar traits to the ones that have happened in the past. And the link there is also a similar product that IBM has produced that you can read about. So these are the types of questions asked every day. What business analytics does is it fills in the X and the Y. Now, business analytics is more than data mining. Statistics is more confirmatory than it is exploratory. It's not like the finding diamonds in a gold mine or coal mine, or the proverbial, the needle in the haystack. What experienced analytics do is they suspect and hypothesize that 2 or more things are related, or that some underlying behavior is driving the behavior seen in the data. And they prefer to fail fast. What do I mean by that? They like to basically have their hypothesis, do an analytical test and experiment very quickly, see what it produced, what did it prove, what did it disprove, and go on and do more and more of them. So statisticians in analytics then search for confirmation and understanding of the relationships. There is a problem though. It has to do with the IT department. I don't want to be critical of the director of information technology, but what users like you who are listening to me, you want these 2 things. You want easy and flexible access to the data and the ability to manipulate it. Easy and flexible access to the data and the ability to manipulate it. In other words, modeling. But oftentimes the IT function prevents you from doing that. They kind of like own the software. They don't give you that flexibility. So now let me contrast business intelligence with business analytics. I'll use sort of a Darwinian evolution. BI, it's been around over 10 years, starts with standard reports. We move to ad hoc reports. Then we get that query and drill down. The acronym OLAP stands for Online Analytical Processing. And then perhaps alerts, upper bound, lower bound thresholds. It's primarily reporting. You react to that information. But business analytics, 5, 6, 7, and 8, takes it to a higher level. Now we can be proactive. We start with statistical analytics, regression, correlation, segmentation. I know some of you took those courses in the university and you just wanted a passing grade and get the heck out of there. Well, sorry, it's here. Data science is here. But the good news is you don't need to go find your old college textbook and brush up on this, but you do need skill sets in your organizations that have those capabilities. Then we move on to forecasting, predictive modeling, and then ultimately, optimization. I call that Mount Everest, as high as you can go. Now, some of you may be asking, well, what's the difference between 6 and 7? What's the difference between forecasting and predictive modeling? Well, I'm glad you asked. Here's the difference. Forecasts tell you how many ice cream cones will be sold in July, so you can set expectations for planned costs, profits, supply chain impacts, and other considerations. But what predictive models do is they tell you the characteristics of ideal ice cream customers, the flavors they will choose, like vanilla or chocolate ice cream, and the coupon offers that will entice them to buy more. So if your goal is to do a better job buying the raw materials for the ice cream and have them at the factory at the right time, right place, your company needs a forecasting solution. This is classic production and inventory control. But if the marketing department is trying to figure out where and which most attractive customers to market the ice cream, vanilla, strawberry, chocolate, it needs predictive modeling. So let me give a comparison or an example of moving from data to business and intelligence reporting to predictions. And I'm going to use a website that does weather reporting. AccuWeather.com is the website, and then the businesses that you and I are in. Let's start with the weather. They have data collection, sensors for temperature, humidity, wind speed, and the like. They can report current conditions. What's the temperature today? What's the wind speed today? And then they have future prediction capability. They have weather models, with partial differential equations, very sophisticated. Here in the United States, when those hurricanes start in this desert in Africa, cross west along the Atlantic Ocean, they'll have these pictures of these sort of like expanding cones. Is the hurricane, it's going to come here in 2 days. Is it going to hit Florida? It's going to hit Texas. It's going to hit North Carolina, where I live. It's where I live now. Incidentally, I'm a Chicago native. That's where I grew up. Business has similar methods. We've got data collection. We have sensors, sales volume, production, customer orders that are in the pipeline, economic conditions. And we report current conditions. Those of you who are listening to me, probably many of you are accountants that close the books, do the profit and loss reporting at the end of the month, so you're reporting the conditions. But you also have some future prediction capabilities. They may not be as sophisticated as partial differential equations, but they can use probabilities for forecasting. We'll talk about that later. So in effect, models help plan our weekend. We're going to have an outing, a picnic, but they also help plan our business strategies future. Now, I want to give an example of analytics that actually relates to myself personally with my wife, Pam. It's how to determine the value, if you will, the selling price of a home. And the reason I mentioned, I can use this example is that when my wife, Pam, and I relocated here to Raleigh, North Carolina, she wanted to basically have a house that has in the backyard a golf course, either a tee or a green or a fairway. We were concerned, we don't want to pay more than what it should really be, what its value is. So by using with our realtor available house data, we found about 60 homes that had, I'll go through the list, similar square footage, similar number of bedrooms, number of bathrooms, size of the basement, size of the garage, all of these characteristics. And then we basically, in that group of 60, about 40 of them just did not have a backyard. There was a house on the other side. 20 of them had a golf course on the backside. We were able to basically see that the difference between ones with and without was $800,000, if you will, or it was $80,000. And we saw what the regular price was. So we actually used this method. Another example would be how banks basically determine the credit worthiness of a borrower that they're going to provide a loan to. So when the borrower comes in to apply for the loan, they already have history on thousands of past loans, individuals, what was their income level, what was their payment history, how much debt did they have when they took the loan, what's their work history, and maybe 24 other characteristics. Then they would put the loan applicant's information in and it would say, okay, this is the amount of loan we can comfortably provide and know that we're going to get paid back. But let's say that the loan basically applicant defaults a year later. Well, then we have new information and they'll be able to put it back into the system. We call that the PDCA cycle, plan, do, check, act. So they're actually constantly improving the model. So what pressures caused interest in business analytics? Complexity and variables are replacing gut feel. There's exponential growth in data, users, and searches. And I love searches. Google as an example to search for things. Volatility, uncertainty, risk, clock speed. And what I mean by clock speed is, sometimes you have to make decisions in near real time, maybe even real time. So let's say you have an employee, they're on the phone with a customer, go or no go, yes or no. They need to make that decision in near real time. They wish they had a tool that they could test immediately that'll help them support that decision. Standardized processes, for example, enterprise resource planning or customer relation management systems. If in your industry, all of your competitors have implemented an ERP system, examples would be SAP or Infor or Oracle. Well, if all your competitors have an ERP system and you also implement it, where's the competitive advantage? You're all now using an advanced tool. So what analytics does is it takes you to that higher level for competitive advantage. And then the intuition of the potential value of unused structured and text data. And what I mean by that is analytics is always not about quantitative numbers. It's not, racked and stacks, columns and rows, zeros and ones, and so forth. It can actually apply to text data. So it can actually read a page in words and then convert it, even verbally, natural process languages, NPL, for example, as I am speaking to you more slowly, and NPL, a process language, can be converting it into computer text and maybe even translate it into a different language. And then enormous IT processing power. This may surprise you, but way back when the very first moon Apollo mission with the 3 astronauts went to the moon, you have more processing power in the mobile phone at your side than they had on the Apollo spacecraft that went to the moon and came back. Now, analytics software tools and skills. Today, there are software tools available to increase analytics capability and maturity in a modern business, but with data technology, but skills are also required. However, software on its own is not the full answer. Good analytics software requires 2 things: analytics talent and quality data. So the amount of experience that analysts have using analytics software is not what makes them good analysts. It's the amount of experience they have deriving insights from data, understanding a business area, and communicating the results. So many organizations think that just connecting drill down or visualization software to or from a database and then creating a pie chart or a histogram, that's business intelligence. It is not. That's just reporting. Business analytics takes it to a higher level. So what are some examples of business analytics? Well, let me start with kind of a funny story. There is a movie star in the United States. You may be familiar with him. I'll give you his name in a second. But at the beginning of their early career, with their the man or woman who basically helped them with their career, they looked at the top 10 grossing revenue films in history. And all top 10 films had special effects. All top 10 films had special effects and an alien. And all top gross revenue films had special effects, an alien, think of this like Star Wars, and a romance line. Who is the celebrity? Will Smith. Look at the movies he made: Independence Day, Men in Black, I, Robot, I Am Legend, Hancock. They all had special effects and an alien and a romance line. But there's analytics are involved in so many other areas: sports teams, crime prevention, music score analysis. But what about business analytics in mainstream businesses and government? Well, here's a big laundry list. I'm not going to go through it. You're going to be able to receive my PowerPoint presentation as a PDF file. You can read all of this at your leisure. I know I'm going very fast, but let's start at the top. Retail sales and merchandising analytics. For the slow moving items in a retail store that haven't sold, they'll move them to the basement, mark down the price. Financial service analytics, risk and loan credit scoring. I already gave you the example, of credit worthiness. Pharmaceutical analytics, drug development, clinical trials. So important during our COVID, where they were developing, if you will, the vaccines. Now, let's see further down, supply chain and transportation analytics, route optimization. You get the idea. Analytics is pervasive. It can be applied everywhere. I'll let you look at this for 10 seconds. It's an example of visualization. Okay, I'm trying to be funny here. This is humorous. Pie I have eaten, pie I have not eaten. It's a pie chart. But let's talk about examples of business analytics for the finance and accounting function. And I want to warn you that the examples I'm about to give are very embryonic, meaning they're at the early stages. Very few companies are actually being as sophisticated as the examples I'm about to give you. But I want to give you an idea. And if you do want to read about these examples, because I'm going to go through them quickly, I authored them in one of the monthly issues of the Institute of Management Accountants Strategic Finance magazine. It was the cover article, Mining the Past to See the Future. You can download the link to it and read it in the link that's in the bottom left. I did this after I retired from SAS. The CEO of the IMA asked me, Gary, we don't want you to sit in a rocking chair down there in Raleigh, North Carolina. They appointed me to a 3-year unpaid voluntary role, executive in residence, and I wrote many articles. So the first example, I got to give you a little bit of a primer on the balanced scorecard and strategy map. You may be familiar with this, created by Dr. Kaplan, Professor Robert S. Kaplan, Harvard Business School, and Dr. David Norton. The strategy map is more important than the balanced scorecard. The balanced scorecard is just a feedback mechanism. I'll give you an example of the strategy map in a second. But above both of them is something arguably more important. It's the vision and mission statement. That must come from the executive team. That's their job. Their job is to set the direction for the company. Their job is to answer the question, where do we want to go? But the strategy map and scorecards answer is a different question. How will we get there? What are the projects and initiatives? So they created the strategy map real quickly. It's got these 4 perspectives that start from the bottom of the top that basically have cause and effect relationships. We start with learning and growth and innovation. So if the employees are accomplishing those strategic objectives, they'll contribute to the internal process improvement objectives. They're accomplishing those, they'll contribute upward to the customer loyalty, retention, satisfaction objectives, and ultimately all the way to the top, to the financial objectives. Each of those arrows between going from bottom to top between the strategic objectives is a key performance indicator. It's a measure. You get what you measure. You can't measure it, you can't manage it. So basically, to summarize, bottom to top, a learning environment will stimulate process excellence. That'll lead to customer intimacy, loyalty, retention, growth, and that'll then create the financial value for owners and shareholders. But here's the question. How do we know whether we selected the right KPIs that will influence the results at the top. And so what I'm showing you is just a screenshot from one of the KPI balanced scorecard strategy map software. So you can see there's the arrows, those are the KPIs. Well, imagine if we take the last 2 years, 24 months of all of the KPI data, and we then use an app. See what I brought in? This is a special app that does correlation analysis, and it will look at each KPI and how much it influences the KPI that it's feeding into. And so the result is, and unfortunately I have a problem with my PowerPoint, so use your imagination, that you see very thick arrows and very thin arrows. Well, the thick arrow reflects the amount of correlation. So the thicker the arrow, the better the KPI. But if the arrow is very, very thin, it means this KPI is moving up and down, maybe 20 or 30%, but the KPI that it's going into isn't moving at all. Well, therefore, that's not a good KPI. We should abandon it and get a better one. So what we're doing is using correlation analysis to validate. Next example, the shift from being product-centric to customer-centric. I'm going to give you a primer, although some of you actually in my previous webinars for the ICMA Sri Lanka, this is a review for you. The only value a company will ever create is the value that comes from its customers, the current customers and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like the existing profitable customers. But we have a problem here. Most CFOs and accountants are not calculating customer profitability. They're stopping partway down in the P&L. They're stopping at gross profit, margin analysis. They're not going below to include distribution channel expenses, marketing expenses, selling expenses, cost to serve expenses. Many of you in the previous presentations have seen this multi-stage cost assignment network. I'm not going to go through it in any detail. It's just a good description of how any organization's expense and cost structure works. You start with the resource expenses in the ledger at the top. We convert them into the work activities in the middle, and then we reassign and trace them all the way to the bottom, to the products and customers and so forth. So at the very end, notice at the very end, the bottom, it's kind of like the predator food chain, like large mammals eat small mammals eat plants. The ultimate end is customers, because they're consuming the products and the pricing, but there's also some direct costs coming from activities. So what this allows us to do is create a profit and loss statement for each customer. And we can get much more visibility about the profit margins. They're layered like an onion skin, layer by layer by layer. And so in this fictitious example, this customer had a 30% composite average gross profit margin, but between the 30 and the 8, 22 more points of profit are eroded, nothing to do with making the product or delivering the standard service, all with distribution, marketing, and selling. And if we calculate this for every single customer, we can put them on a grid where each circle intersection is a customer. The vertical axis is the product mix, gross profit volume margin. And then the horizontal axis is the cost to serve, low to the left, high to the right. High cost to serve, those are high maintenance customers. Example, they're always changing delivery schedule. They're never buying standard, always special, always calling help desk, always returning goods. So now the name of the game is move the dots from the bottom right to the upper left by taking actions to make customers more profitable. So that was sort of a primer setting you up. Now the question is, for those organizations that are due customer profitability, they then have a question: what differentiates the most profitable customers from the least profitable customers? We can do this with a decile diagram. So imagine, you're one of these few organizations, companies that calculate customer profitability. Let's imagine that they have 10,000 customers, okay? Well, the top 10% is to the left. The top 10% of those 10,000, the top most profitable 1,000 would be roughly 10 million. You can see it. Then the next 10% profitable, a little bit more than 2 million. But way to the right, the least 10%, the lowest profitability 1,000, we're losing money, losing more than 2 million. So now the question becomes, what differentiates the most profitable customers to the left with the least profitable, unprofitable to the right? Well, we could hypothesize. Maybe the ones on the left live in, wealthy neighborhoods. The ones to the right, they're not in wealthy neighborhoods. Maybe the ones to the left are senior citizens, older people. The ones to the right are teenagers, young people. Why? Because the older people have more money. Or maybe the ones on the left are males, the ones to the right are females, or the other way. Or maybe, or. What I'm saying is we could hypothesize forever. Why not throw the computer at it? And there is an analytical technique called recursive partitioning with decision trees. And how this very sophisticated method works, and there are some companies using this, at the very top, it will go to the customer master file. Now that it knows the customer profitability ranking, which is a dependent variable, it'll look at independent variables. Where do they live? What did they buy from us? How much did they buy? How frequently did they buy? What was the price? What was their age? All of that. And it will search to find out what is the number one differentiator. And in this example, it was the average order size. So those basically that were more than 10,250 versus less than 10,250. So then put them into two buckets. It'll do the same calculation again and again and again. So what we're providing now is a marketing and sales function information, what differentiates more and less profitable customers so they can take the actions that produce the higher profitable customers. I'm going to skip the next section here. It has to do with budgeting, just in the interest of time, because I know I'm going to go too long. The message really here is that the budgeting process is typically broken, and we need to replace it with, if you will, performance management methods. And one way to think about this is you basically have two, like, if you will, streams of demand coming in at you. You've got the recurring, repeatable expenses at the top, and then we've got the non-recurring expenses at the bottom. Those will come from strategy projects, risk mitigation projects, or capital projects. And not going to go through this decomposition. You can examine this when you get my PowerPoint slides as a PDF. But where I'm headed on this is basically the annual budget is typically out of date in a couple of months. So we need to do reforecasting to get to driver-based rolling financial forecast, keep updating the forecast. But typically when an organization does any forecasting, they do it with just a single point. So look at the diagram to the left. Everything is like, well, we made all these assumptions about variables and forecast and the like. In some cases, some accountants, when they're doing their budgeting and their forecasting, they'll ask the managers, well, can you give me the worst case as well as the best case? So they've got, if you will, one to the left of the base, one to the right. Well, let's imagine that we ask the managers that are submitting the information that we want them to give us 7 variables that influence the budget. Maybe commodity prices in a country, wages in different countries, and so forth. And now we not only just want a worst and best case, but we want 3 worst cases to the left, 3 best cases to the right. So what I just described to you was 7 variables and then 7 ranges on the diagram. Well, what's 7 times 7? 49. We can basically use our FP&A software. We got to use some computer software to get all 49 combinations. And that's what we're seeing to the right. It's a distribution for the most extreme are to the left, most extreme worst case, the most extreme best case are to the right. It's called probabilistic planning scenarios. Finally, correlation of activity. Actually, I'm going to skip this one as well. I want to just get near to the end so we have some time for Q&A. It was just another, that was a fourth example. I didn't show it to you, but again, if you go to that Strategic Finance Magazine article that I gave you the link, there's many more examples in that article. Now, this is a little bit scary. It's the disruptive digital revolution. There are definitions of disruptive innovation and technologies. This is a definition out of Wikipedia. A disruptive innovation is an innovation that helps create a new market and value network and eventually disrupts an existing market and value network over a few years or maybe even decades, displacing an earlier technology. The term is used in business and technology literature to describe innovations that improve a product or service in ways that the market does not expect, typically first by designing for a different set of consumers in a new market, and later by lowering prices in the existing market. The digital revolution. The accounting profession needs to prepare itself for substantial change and a threat to jobs in accounting. This is because there is an accelerating and disruptive digital technology transformation in progress. It is referred to as the digital revolution. It can potentially adversely impact an organization's competitiveness, and it will be replacing some employee jobs with computers. And I am referring to you and some of the people that are in your department, clerks, accounts payable, receivable, and the like. So there are threats to one's job security. Examples of digitization disrupting traditional industries such as Uber for car passenger, that's the taxi industry, and Airbnb for residence rentals, that's the hotel industry. They are just the tip of the iceberg. It is another category of digitization. Artificial intelligence, AI, including machine learning with algorithms, robotic process automation, cognitive computing software. They're the ones that will create the dramatic changes. Digital transformation is not exclusively about physical robots, like in an automobile factory, but also about software robots that perform functions that white-collar employees perform, such as you. Digital transformation presents great potential, but also raises concerns. It can provide invaluable business enhancements, but also a threat to one's job security. So what the computer will do is it'll observe the worker's task. Let me ask you this. When was the last time you reached a live telephone operator when you called the company? Consider that an example as a preview of what lies ahead. Consider the legal industry as an example. Computers already streamline the manual search that a junior attorney in a law firm labors at when they're doing what's called discovery. They're looking at all the past cases. So computers define business rules and learning derived from observing human experts who perform and complete repetitive tasks. Computers will render some jobs as obsolete as with the telephone operator. So an example may be an accounts payable clerk. The computer will watch the clerk basically doing all of the processing of the payables. And after a while, after maybe hundreds have been done, the computer is going to say, Miss or Miss Clerk, set aside. I'm now going to do the work that you did. Maybe there'll be an anomaly that the computer doesn't know. The clerk comes in, hits a few keystrokes, but the computer remembers it. Same thing for payroll, same thing for invoicing. So there are 5 impacts that automation is going to have on the artificial intelligence is going to have on accounting. We'll start with number 1, the effect on transactional accounting processes. I already gave you the example of the accounts payable clerk or the payroll clerk. The next one is the effect on period end closing. Some of you, and I was a division controller when I was 27 years old, so I know what closing the books is all about. Sometimes it takes, 2-3 weeks to go through all the T accounts and all the journal entries and adjustments. But with a computer can basically look at all of those transactions and basically do it in an hour. Number 3, the effect on auditing. And any of you who are with a CPA firm, listen to what I'm about to say. The audit is going to be replaced by a computer. It's not going to be doing sampling. It's going to look at every single transaction that the young auditor, typically when the auditor is with their client, is examining and sampling. There'll be no sampling. It will be 100% because the computer is that powerful. And if you are with a CPA firm, what this means is the audit is going to basically be replaced. If you want to contact me, it really means you've got to move. The CPA firm needs to move to advisory services to provide consulting services to their clients. Not very many of them have those skills. I can coach and train CPA firms how to implement some of the CPM systems. Feel free to email me about that. Number 4, the effect on business process outsourcing, BPO. You know, when your neighbor there in Bangalore, India, you know, I've basically visited, because I've done a lot of visits to Bangalore, Hyderabad, Mumbai, Delhi. Those sea of desks of all those outsourcing, like Infosys, 300 desks, many of those clerks are going to be replaced with a computer. And number 5, the effect on regulatory filings. Here in the United States, there's software called XBRL. It basically means once you close the books, it will automatically send the file to the tax authorities or to others. Now, I'm not going to have time to go through the next with all of those. If you, I think, go to, I'll have it somewhere, or just send me, I can send you links to articles that describe what I just previously described in greater detail. If you have time, go to YouTube and download and watch. It's a 20-minute video. It's called Humans Need Not Apply. It's also in this link, in this slide. It's very frightening. So let's start concluding the presentation. What are the benefits from applying business analytics? Well, you get a higher return on investment from leveraging automation. You get deeper and actual insights and understanding. You get to start reducing uncertainty and managing risks because you can basically see all the possibilities and be proactive. Remember, not just reactive with business intelligence, proactive with business analytics. It's more intelligent, systematically tested decisions, a lot of those hypothesis tests. You know, in the United States, there is a credit card company called Capital One. And what Capital One marketing people will do is they'll do experiments. They'll send out an email, but it'll have blue colored font or red colored font. And then they'll see what's the difference between the blue and the red. And they'll do many experiments like that. It's a bridge to a culture of optimization. So integration of data, data science, and technology. Accounting professionals should fully embrace the integration of data, data science, and technology. They should partner with experts because it will have a transformational impact on future business and operating models. The limits or barriers on information flow are beginning to crumble. Those who prepare for this change will be at the forefront of accelerating value creation across an enterprise. And accountants are well positioned to drive this evolution as thought leaders. So to conclude, action steps, get educated. Well, thank you very much. Those of you that are actually attending this webinar, that's what you're doing. But also start thinking about how are you going to get buy-in from the people in your organization to basically proceed. And here's why. You know, the real barriers that are slowing the adoption rate to a lot of the methods, to things like activity-based costing, analytics, has nothing to do with systems or technology or processes. It's all about people. It's resistance to change. It's human nature. People like the status quo. They don't like change. You know, only babies like change, changing of diapers. And they have fear. They have fear of others knowing the truth. They have fear of being held accountable. They have fear of being measured. So if you want to basically successfully implement all these methods, you've got to have some change management skills, behavioral change management skills. And how many of you have degrees in sociology or psychology? None. You're all accountants. You know, you're what I call Newtonians. I am too, like Isaac Newton, the physicist. To us, the world's a big machine. Just give me the levers, the pulleys, the dials, the gears. You know, you need to be somewhat Darwinian, like Charles Darwin, you know, sense and respond, the organization. Other action steps, rapid prototyping, those of you who attended some of my previous, I guess, 8 webinars, I described how you can implement activity-based costing for profitability in 3 weeks, not 6 months. I described a method that you can create a strategy map and a balanced scorecard in 1 day, not 5 weeks. So under the resources, I do have 4 links. One of them is to the first chapter of the Predictive Business Analytics. Okay. Oh, and the third and fourth one, see where it says WWWAIIA? I forgot. Those will walk you through the artificial intelligence, robotic process automation, and so forth. Remember, I showed you the 5 effects that AI and RPA will have. The articles are in the third and fourth link when you get this. So from theory to practice, success depends on how well and how fast the right information gets to the right people. There is my email address. If you care to send me questions, my website, if you go across the horizontal tabs, there are many, many links to articles on a lot of the topics that I've been talking about. So I'm going to stop sharing, return back to Lakshman, and I hope I didn't speak too fast or too much, but I'm done. So our comments, or sometimes some of your visitors have a reaction to what I described.
Thank you very much, Gary. I think that was a detailed description on the topic that we were talking of on the predictive business analytics. I think you went through most of the areas. I don't know how familiar it would have been for the accountants, because as you were talking of data science and data analytics, whether maybe we were speaking to more the engineering and the science graduates, mathematics graduates, maybe, because I know that there are many of our accountants with those qualifications too. But it is something that where we need to look into. And if you have any questions, please send it on Q&A. Already we have a few questions that have already come up. But I just want to ask Gary now, because from the accounting side, what we really hear is of data analytics. Now, you have gone a step further, and today what you are speaking of is on the predictive business analytics. Can you just describe now this, because I think there is an evolution of data analytics, and that the predictive is also one area that we are into. Can you just give a short description of this when we say data analytics? What should be the coverage that should be there?
Yeah, well, actually, the title of this presentation was misleading. It was Predictive Business Analytics. But if you remember my very first slides, I basically said I showed the continuum. You have the data analytics, which is looking backwards, last month, last quarter, last year, and business intelligence tends to look at historical information. So that's where data analytics apply. You get insights, you get inferences, you can see trends and and the like. So there's value in data analytics. Now I want to warn, some of the accounts will be saying, well, I'm already using analytics. I'm using ratio analysis. I'm doing inventory turnover rates. I'm doing day sales outstanding for accounts receivable, DSO. And my answer to you is, those ratios were in textbooks in the 1970s. That's way back, What we're really talking about is regression, correlation, segmentation. And Lakshman, you are correct that in my presentation, I was talking about data scientists and the engineers and those with statistical experiences. But my message really to the accountants is, don't sit back and think this isn't going to affect you. You're going to have to basically get some of these skills. And, some of your jobs are at risk because the computer is going to replace you. So, the solution is get certified, get education, get a CMA, get a CPA, whatever. It's lifetime learning. Don't just sit back and say, well, I've learned everything I need to know. And that's what I do in my job. You know, your job could be at risk. So data analytics is you can use it, Lakshman, on the historical view.
Thank you, Gary. Now on the questions, there's a question from Lakshan Fernando. Hi, Gary. With the current economic crisis and the situation in Sri Lanka, how can we do predictive analysis and forecasting? Because all the data change daily on a daily basis. Please advise. Then,
Well,
okay.
no, I can answer. Any business is not static. Static would be, you know, repetitive, same things happen year after year, the same customers buy the same product, same volume. Absolutely, your question and observation is essential. Things are dynamic. And now with the economic crisis, you know, not only in Colombo or your country or Sri Lanka, but geez, Europe's got all sorts of weather problems. Different countries have political problems, authoritarian, you know, leadership. United States, we've got craziness going on here. The answer is modeling. You keep refreshing a model. Models are a physical representation of, you know, physical things. So, and forecasting is a key part of it. So you need good forecasting, volume and mix of what products and services will come in. And so there are really good forecasting tools I didn't mention, I probably shouldn't, you know, some of the popular commercial software vendors are Qlik, Qlik, Tableau, which I think was acquired by SAP, Microsoft, Power BI, SAS, my previous employer. So those are the software vendors. And then the academics, some of the professors, they have what's called open source free software. One of them is called Python, Python. One's called R. And, you know, with a little bit of skill, if the casual learner can actually use these tools. Okay, next question.
Yeah, thank you. There was a balanced part on that question. I don't know, I think you may have answered some of it. Please share with us business analytics examples, sometimes confusing. We need to use Stratawise, like software of Excel or Google Sheets.
I'm not sure. I'm not familiar with the Stata Wise. I'll have to look that up, but I think I just answered your question with the four of the vendors, and then and R and Python, the open source.
Right. Thank
Let's
you.
go to the next question.
Yeah. That's an anonymous question. Will predictive analytics improve if we use a strategy, what if strategy? In other words, by what if strategy always has an alternative options, so the negative results could be projected into positive.
Well, the strategy map that was created by Kaplan, Robert Kaplan, Dr. David Norton, is really about strategy execution. And where analytics can come in, and I'll just use this sort of phrase, can you afford your strategy? I'm going to say that, can you afford your strategy? See, the executives are pretty good at formulating strategy. And then the strategy map actually is a diagram that kind of visually describes the strategy. But some of the executives have aspirations that are so high that it's not achievable. So by using management accounting, we can do things like projecting the capacity, how much to spend on number of employees, types of employees, spending with suppliers and the like. It's basically modeling. It's a little bit of industrial engineering 101. Remember, my undergraduate was industrial engineering. You know, you volume and mix times unit level consumption rates equals, you know, the amount to spend. So, and then what if scenarios? Once you have a base model that's working pretty well, now you've got independent variables. So let's change the variable for sales volume up 5%, up 10%, recalculate, up 10%, recalculate, down 5%, recalculate. Every time you recalculate, the end is going to be a pro forma income statement and pro forma balance sheet. And everybody knows what's the next thing after you've got an income statement and balance sheet. net cash flow. And that's what board of directors are looking for, especially with COVID. And also back to your current environment where things are kind of crazy with different companies, which companies are going to get impacted, what's not. The board of directors want to know, are we going to basically go bankrupt? Are we going to have to borrow money from the bank? Are we going to have to issue equity stock? Are we going to have surplus cash? So I hope I'm answering your question.
Thank you, Gary. The next one is from Shemal Fernandopulle. In business analytics, how important to do sensitivity analysis for various scenarios and various assumptions? How important is to do here?
Yeah, I think it's very important. And I think I just, in answering the previous question, I already sort of gave you the example. I said, once I've got a good baseline model that I'm forecasting, and it starts with initial assumptions. Again, if I increase the sales volume and mix by 5% or lower it, or if I increase, let's say, the purchase price from supplier for a commodity item, or if I basically increase productivity, that I say, well, let's have a 2% productivity improvement from lean management or Six Sigma or all the process improvement. Each time I'm changing that input variable and calculating, I'm going to see the impact on the bottom line profit. Now, where does sensitivity analysis come in? Well, if I do enough of those changes of variables, I can see which variable change had the biggest impact on the profit. So that's what sensitivity analysis, it's really like, where is our profit most sensitive to, less sensitive to? Okay.
Right, thank you. Next question is from Angelo Arasaratnam. How are humans going to cope with unemployment when AI replaces our job?
It's a scary question, and it's a valid question. Again, I encourage everybody to, in the next week or two or soon, go to YouTube and enter "humans need not apply." It answers this question, and it basically says, look at globally. It's not just going to be accounting jobs, truck drivers. When driverless trucks come into play, drivers are the huge population of employees. So there are going to be a significant unemployment. In fact, in the video, it actually gives examples way back to the Depression in the United States when there was like 25% unemployment. So now the answer is how to cope with it is really about education, learning, growing, always moving to something where you can be bringing more value. So.
Thank you, Gary. The next one is from Prasanna Indrajit. How do you do predictive estimations such as GDP, interest rates, etc., based on highly varied published data by, say, central banks, IMF, World Bank, etc.?
Okay, Prasama, that's outside my pay grade. Meaning, you're probably an economist but it's a valid question. But, all of that information from the World Bank, from the International Monetary Fund, different countries, regulatory agencies produce that information. So your question is, how do you do predictive estimations? I'm not sure I'm clearly understanding. First, I would use the estimations that those organizations already are providing. But if you're asking the question, I'm in one of them, how do we do it? I'm just, go to SAS, go to the Alteryx. That's another analytics company. Look at their web pages, look at their white papers, and hopefully it'll help you. So. Okay, Lakshman, I think we're at the end.
I think, yeah. So thank you. Let me thank Gary Cokins for a very excellent presentation. I think this is a specialized topic, and I think we have given a lot of clues to those who have been attending it, how they can improve themselves. And I'm sure that that would have helped all our participants because they have seen the value for it, and that's the very reason that they have been present. So let me thank Gary once again, and also all our participants for their valuable attendance today, and also for the questions that have been asked. and to Gary for the topic that he has given, because we are now, I think, going to higher levels of how maybe the data science and artificial intelligence and the data analytics, all these areas are going to help the accountants. And if they stay in one place, I'm sure that they are going to get sunk. So you are giving us warning signals as to what we should do in order to come up to those high levels. So thank you very much, Kerry, and we wish you all the very best. And I'm sure that we have one more coming later, and we will await your participation and your presentation at that. Thank you, and good day for you, because it's morning time there, and have a good day. And
Thanks, Lakshman.
good
Thank
evening
you,
for all
Lakshman.
others, and good night.
Yeah, it's always a privilege to present for the ICMA Sri Lanka. Goodbye, everybody.
I think Gary, we don't use the term I. We go as CMA.
Oh, okay.
Like
Okay.
so, we go as CMA. Now, actually, all the management accounting bodies are using CMA, and we also have the same term of. Some of them go as cost and management accountants, some are chartered management accountants, some as certified management accountants. So different names that are there. So thank you, and we hope to see you later, maybe next month. Okay.
Bye-bye.
Thank you. All the very best. Yeah.